Well, thank you so much for today. It is Friday and it is the beginning of March. So if you haven't filed your taxes, you must be nervous about all your forms and getting an appointment with your tax preparer. Hopefully, the presentation today helps you a little bit about like what to expect, and there is something maybe to learn about your taxes and what you need to be paying attention to when you are bringing your documents to your tax preparer. Okay, so let's see there. Okay, so where did I learn actually taxes? So I went to work for a few years actually in the Mission District in financial capability as a coach. And the first thing that I get there is a big binder so I can study for the VIDA test. So that was my first opportunity to do taxes for people. And that was my biggest school of taxes. So for people that are more interested in taxes, VIDA programs are a really wonderful way to volunteer and learn about taxes. Alrighty, so let's keep going. So this is a presentation, and I'm just sharing some of the information that I have with you today. But this no, by no means this is any advice or personal recommendations, as everybody has a personal situation. Already, what are we talking about? Filing statuses. We are going to speak about the children, how do children change your status when it doesn't. Also, what are dependents and how do they relate? When are they actually dependents of yours or not? Education, so are they on any credits and how you can continue getting support through the system by continuing your education. And also, we are going to cover mixed status families, so people that have Social Security and ITIN holders in your taxes. And I'm gonna talk a little bit also about the IHS. So when you are caring for somebody else, and you are able to either make have an earned income or have that income but not being taxed. So we'll cover that a little bit at the end. All right. So the filing statuses. So we see single if you are unmarried, married filing jointly. So you're married and you decide to do your taxes together. Separately, we will see why people might be wanting to do filing separately. Head of household, when you usually are separated, actually you're single parent or separated officially, and we will see what that means, or divorce, and you have children as dependents, or dependents that qualify you. And qualifying with the word that is, if you have a child, you can do that for a couple of years, and then you become a head of household. Already. Um, so let's see. I will go back to that. So let's just go here. So your filing status is determined by how you are, so let's say you are getting divorced and you get divorced on December 25th, and you say, well, I was married most of the year. How do I file? Well, what you are, so if you're divorced on December 31st, then you are going to be either single, head of household, depending of what's going to be qualifying you for a status, right? Same thing with getting married. You might get married on the 31st of December. You will think, well, most of the year I was single, so I should file single, right? No. Now you have to file as a married couple, whether you're filing jointly or separately, but now you are married because of December 31st, you are married. So it's important to know that, especially when there are children, because then they might be giving you a filing status of, that will help you better with your taxes and keep more of that money. So why is it important? Well, tax brackets matter, credits and eligibility, whether you have dependents, or even we will see other credits like, for instance, credits for education that sometimes, well, not sometimes, or you cannot get it when you are filing separately, but we will cover that. And the standard deduction, of course, it's higher when you are, for instance, a head of household versus a single parent, but that's not a child that you can claim as a dependent. So let's just have a look here. This is just for fun. I have this 25, 26, but let's take a look at 26 here. So if you look at these filing separately with head of household, if we look at the numbers at the when you get to the 24, they look the same or almost, right? Almost. uh, but at the beginning here, look at how it's different, where the brackets do change a lot by being head of household or filing separately. So that's just an idea about how brackets might have to do with how you file, right? So it's important to know that it does get affected. Of course, the standard deduction, as we know, well, the when you're married, you have a double, right? So double of 16,100, for instance, in 2026, and then a head of household is somehow in between, right? And there is also senior bonuses, or if you're blind, and there is a new bonus of 6,000 that you might qualify for, depending on how much you earn. Okay, so there is also a option of itemizing. Uh, in the last few years, standard deductions have been more of a to go for so many people because the SOLD, which is the state and local taxes, where you include the, if you own a property, you include taxes, you include interest. And in California, as we know, it could be very high, higher than 10,000. So now with the coming back of having a higher number, in this case is 40,000 for married filing jointly, that you can deduct if you itemize versus last year, right? We were looking at 10,000. It's possible that more people are going to be itemizing. So I have seen some of my clients who have new homes, right? They're so expensive that there is a lot of interest in taxes that they have paid, and they are itemizing when they didn't last year. So that might be an opportunity of why the standard deduction might not work, because you're actually getting more through itemizing your taxes. There are some things that you need to know about mortgage interest up to 750. So if you buy a home that is 1 million, it might not be like you cannot consider the full amount for the deductions on interest and well, taxes still go there. But yeah, so it's don't worry about that. The software does that for us when we prepare your taxes. Medical expenses, that's another reason that people might be itemizing, because if they have a lot of medical expenses, that is over 7.5%, because you cannot deduct the less than 7.5. It has to be over the 7.5 of your AGI. And then, that might be another way that you might want to itemize your taxes. And if you are a charitable oriented, so you give money to your church, your causes, or make sure that you are doing it in a way where you are getting all the documentation, proper documentation, and it should qualify as a nonprofit. So you can have those, and you should bring that to your tax preparer. So these are a few reasons of why people might want to itemize rather than taking that big standard deduction. Again, software does it. So you bring your information, and then we enter that information, and the software, a good software, will give you the best outcome. Okay, so SOLD deductions, federal. That's that 40,000 is federal. Okay. And by the way, and you will see a slide later, for California, it goes up to 1 million. So it didn't change. Remember, it was 1 million years ago before the TCJ, the tax. Okay, I'm not going to try to remember the name, but then it was 1 million, and then it went to 750. Well, California kept the 1 million. All right, so mortgage interest, medical expenses, as we saw earlier about the 7.5, the SOLD and charitable contributions. And also for people, this is for this year. You won't see it on your taxes that you're filing this year for last year. But you're going to see it in your 2026 that if you are non-itemizer, so you're taking the standard deduction, you can take up to $1,000 in cash contributions. And again, have proof of these contributions to nonprofits, to qualifiable organizations anyway. Okay, so let's go to this piece of when does it become an important piece in your home. You probably are attending here because you don't know if you qualify as a head of household. So we will see that mainly children are the piece that are going to give you that access. Already. So why people want to be head of households when they can, when they qualify, of course. Well, there is filing jointly, right? So if you have children, child tax credits of 12 to 22 up to 2,200. That doesn't mean that everything you're going to get everything back. It depends of how much you make. And this is a AC. Wow, what am I? I'm blanking on what the A stands for, but that's the part that is going to get is refundable. So even if you don't make enough, so you can get the 2,200, the ACTC might give you the 1,700. And there is a phase out, with child tax credit is 400,000, and that 400,000, well, that's if you're filing jointly. We will talk about what happens if you make more than that, right? Is there any other way that you can take care of your children when you're not getting child tax credit, right? And still get some kind of support or help deductions on your taxes, on your income. Then there is Mary filing separately here, right? And look at that, what happens when you're filing separately. We will see that a lot of credits might disappear as you file separately, right? So we will look at that. And then head of household, you still get it 22. You can get that 1,700. And you are earned income tax credit eligible for people that have the income, the lower income. And then there is a 200,000 phase out. So let's see. Yes, the chat. If I don't see it as I go, we're gonna have a chance to go over that after the presentation. Alrighty. So head of houses, as we noticed in the previous slide here, is that you might be able to protect more of that money, keep more of that money in your pocket, right? So a lot of people are trying to find out, okay, well, it's like, can I qualify for head of household since I will be able to shelter about $8,000 more. So there's better tax brackets as we saw earlier, and also, well, the credits that you might be able to get into by qualifying as a head of household. All right, as we saw that, so you will see a lot of repetition here because maybe we need a few ways to explain this. So there is higher standard deductions, access to favorable tax brackets, eligibility for child tax credit, earned income credit as well. Filing separately, it has lower standard deductions. Many credits are going to be disallowed, like earned income tax credit, child tax credit might be most likely not available. And yeah, so there are reasons of why people might file separately. All right, head of household, you must be unmarried or considered to be unmarried. So if your spouse hasn't signed that document, but you are not living with your spouse, and you did not live with your spouse 6 months, the last 6 months of last year, in this case 2025, in the last 6 months of over 6 months actually, so let's call it 6 months and 1 day, you didn't live with your spouse, that could qualify you federally as not being married. So we have to be careful with that because California, and there is a set of questions that your tax preparer or your software is going to ask you, and it might not be, and it's a little bit more complex for California, but this is easier. This is you're gonna be a head of household here. The problem starts with if you don't have a child, right? So as we will see, somebody else can make you a head of household, like let's say your parent. But it's possible that the parent doesn't make you a head of household or doesn't allow you to qualify for so many things in California. But right now we are mainly speaking about federally because that's where the bigger standard deduction is and all that stuff happening is happening for you. And also for children, they are the easiest way for you to get qualified as a head of household. So unmarried or considered unmarried, you paid more than half of the home cost for your household, and you have that qualifying person living with you. Okay, so let's say Mary has the child, right? Solo that mark, what happens? Well, if there's only one child and that child lives with one parent, usually, even if you have two or more, it's very likely that they live with only one parent. As we have seen, like keeping the children together once in a while is not, but usually that's what happens. So what's going to happen is that, well, if they are not on, if they are still married, he might just have to file separately because he doesn't have a child to qualify him as a head of household. And he won't be able to claim the child tax credit. And there's going to be a lot of things also that, as we will see in a few slides, that he won't qualify for some credits that he might be able to get if he was filing jointly or if he was single, if he was divorced. So we have to be careful when we choose in having a good relationship and communication with a strange spouse. So we have so we know that who is going to be claiming who and who is going to be supporting who. All right, so there's also the piece of custodial and non-custodial parents. Custodial parents is the child living with you. 183, that's more than half a year with you. You can claim that child as a dependent and qualifies for child tax credit on your taxes. It makes you eligible for the head of household, and you can get into the earned income tax credit. Non-custodial parent doesn't leave the child with you. There is something where if you have children that, and you go to court and then court says, well, half and half, half you have the year you have year the other person. It's hard sometimes to determine. In many cases, that custodial person is going to be designed where there's only one parent that has the majority. But there is some form, the 8332, and I'm not going to go deep into that, but just know that there is a form that might allow you to have the custody of the child, but not because that child has, but you have that form is going to automatically qualify you for other things. So just be careful with that. So you cannot claim that child tax credit. You cannot file a head. This is the most important. You cannot file that head of household. There's going to be only one person, even if the main person signs this form to you, so you can claim this child. And that doesn't give you also access to the EITC. So again, custodial parent is that parent that it has, and usually this is given in court. So you go with through the process of divorce, and there is one person who is going to be chosen to be the custodial parent. And again, there is a form 8332 to provide a little bit of access to have a dependent for your taxes, but just it's very limited. The power that you get with that form is very limited. So make sure to have the written agreement when the custody of your child is you're very contended, then usually what the judge will do is, okay, so let's find out who has the higher AGIs. That's the person that is most likely supporting the children, who is having the child more nights, and is there any written agreements that we can set here? So there are some pieces that might be established for you. All right, more of this. All right, so more than anything, it's important for you to have a good communication with your spouse, because it has happened that both spouses or both parents, even if they're not married, they're trying to declare the child as their dependent. And that might trigger flags that might disallow you from filing the child as your dependent next year. So open communication with the other parent is very, very important. Otherwise, you might get in trouble. And by the way, don't miss out that one upcoming class with Heather list on that, to get you even out of trouble for with your taxes. And so, yeah, so make sure that you have the all the information, and also the tax preparer might be asking you questions. Actually, they should be asking you questions, and you might be needing to go to prepare your taxes with forms, including the Social Security cards of your children, to show that yes, you are the custodial parent, you are the parent that is qualifying as a head of household. All right. What else? Okay, so if it's your child should be under 19 or under 24 if a full-time student. There is residency test, the 183, which is over 6 months, and the dependency, right? The child must be your dependent. You must be unmarried. You must be paying over half of the household expenses, and so you lived apart also from if you are still married, apart from your spouse, the last 6 months of the year. Qualifying child, so relationship, it can even be your stepchild, right? Sometimes it happens. Foster child, right? Or any descendant. The age, as we saw, residency. And yes, your child can, this is a very weird situation. And I haven't seen one actually where your child is married, but it's your dependent. I guess if they are too young, they got married earlier. But yeah, so this is another question that your tax preparer or your tax software is going to ask about, if your child or if your dependent is married. And of course, you have to provide that support, over 50% of that support in that for that child's life. When the parent don't qualify for head of household, the child is primarily with the other parent. You don't cover more than half of the expenses, and you are still married, living with your spouse, and you're trying to claim head of household. That is very difficult, because it's usually, again, as a head of household, you're gonna have to prove that you haven't lived with your spouse. Alrighty. This is a list of things that credits that you might get. Oh, here's the word that I miss: additional child tax credit. Uh, Credit for other dependents. We're going to take a look at this. Earned income credit. So you have to have income in order to get this credit. Child independent care, education credit, adoption, medical expenses, and other itemized. All right. So if you're filing separately, look at what you could be missing. A lot of credits, right? So that's why it's so important. And yeah, so maybe divorce it's the right thing if you're going to be separating from your spouse, and not drag it along. If there is any reason of, like, if you are no longer wanting to be with your spouse, maybe getting divorced would be a better way for you to be able to have a lot of things back in your life with your taxes. So some of these drawbacks is that tax credit laws, deductions are restricted, as we saw, like student loans. That's one of them. That your interest might not be deductible, and IRA contributions. So one of those Mary filing separately is that you can, if you make over 10,000, right? If you make over 10,000, you cannot put any money into your traditional IRA, for instance, or Roth IRA. So you do miss out a lot of things by filing separately. Um, and you will wonder, why will they then do that? Like, why do parents file separately? Well, sometimes because they are just not through the divorce. I mean, they're just separating. There is liability separation. Sometimes somebody has a business debt that they just want to make it clear that who is whose debt. Um, Unfortunately, sometimes it's even bad debt, like gambling debt, and you want to be just, there's other ways that you can claim separation of debt with your taxes and with your spouse. But often people, if they have so much debt, might decide, or they have their own business and they want to keep it separately. They want to file separately. And this is a big one. And I do a lot of student loan planning, repayment planning, and even in California. And I will cover that and why it might be or it might not be a good idea in California, because in California, half of the household income is yours. And that's what you're going to claim on your federal taxes, just because you live in California or in a community property state. So student loan planning might be the reason of why you're filing separately. And sometimes they just disagree with things and they just want to file and have things separated. But from what, in my experience, this might be a big important piece. All right, so child tax credit, 2,200 per child, 1,700 for the additional child tax credit, and then the phase out starts at 400,000 for married filing jointly and 200,000 for married filing separately. Alrighty, so let me see. Hi, Heather, in the chat. All right, so state and local taxes, that's the sold. Uh, I'm sorry. So sometimes we use words that it's like so short and easy that we understand, but yes, it's state and local taxes. Okay, how the phase out works? Well, anybody who makes over 200,000, they start getting a phase out of $50 for every 1,000 they make. So that is going to be that window between that 203 and 500 and 600,000, or 400 and 500, 400,000 and 500,000 for married filing jointly. All right. This is an example of because of child tax credit not being there for people with higher income at some point, there is a way around if you have access to um, FSAs for child dependent care. And this is again, if you have that from your employer, right? So if you can contribute up to 7,500 for per family in 2026. So if you do have that and you are a higher income earner, you might want to look into that, and in that way you get that deduction pre-tax because you won't be able to get the child tax credit. So there is no double dipping. You cannot do one thing, get reimbursed, and also turn around and do the child tax credit. So that's very important. You don't want to be caught doing that. Um, but if you won't have access. So if you have access to the FSA still, do that. And then if there is anything else that you spent on, you might be able to do or might qualify for child tax credit. So, but this is mainly this is slide. I'm just put it here because if you have that FSA for your child and you are a higher income earner, that might be the way to protect some of the money for the care of your children. Refundable and non-refundable. So what is refundable? Refundable is money that is going to be given to you pretty much, even if you don't have a tax liability. So there might be parents that don't make, they don't have that much income, or after doing all the math, the standard deduction takes down the tax liability, right? And then there's no liability. There is no taxes owed. And you can still get the additional child tax credit. But if you do have a tax, so that you do all the math, and then there is a tax number or a liability, or you owe taxes, that's when you might be able to get another $500, right? So that way it helps down your taxes. As we will see, this is the child tax credit. Other dependent For other dependent credits, so for those kids that on December 31st were 17 or up, you might be able to get the $500 too. And that is a non-refundable. So that is given to you only if you have a tax liability that can counter that liability, and you get the rest. So if, let's say, you owe 1,000 and you have a child over 17, that person or that child can give you the $500 off from that liability, and you just owe now 500. So that's something important to know. So sometimes you go do your taxes and you feel like, where is my 2,200? When you didn't have enough income to get some of the $500 back, but you might still be able to get that 1,700. Okay. Under 17, residency, relationship, and citizenship, child tax credit. Okay, so we will go back to this piece, but I just want to go over what has changed. And here, for people that have family or a taxpayer, children with ITINs, this is what we're going to cover here. So what changed is that there are some things that people with mixed families that might have to do taxes or think taxes differently this year. And that is because this is how it will work. So let's see, the mixed status. So if all of you have Social Security, valid Social Security numbers, everybody in the family, or the child, will be able to have 2,200, up to 2,200 child tax credit. For mixed couples, and this is something that you need to be aware of, because if one of the spouses has an ITIN and your children all have Social Security, put the person that is a Social Security as a main person. So that taxpayer, the main taxpayer, is the one with Social Security. I'm not sure if that will matter, but I will be safer that way. That's how I would be doing taxes for my my clients. If I had this situation, I would put the main person, the person with Social Security, and then the spouse is the ITIN holder, so my child can have a child tax credit if there is Social Securities for one parent and the children. So it's ITIN holders. If both parents have ITIN, unfortunately, there is no child tax credit. The other dependent credit, which is a much lower number, again, is $500, that is available. So that is unfortunate, but that's what's going to happen. The CTC is going to go away for 2 ITIN taxpayers. Okay, so here again, if the kids are US born, both parents have ITINs, they cannot claim the child tax credit or the additional child tax credit, right? One parent has Social Security, the other one has an ITIN. The family may qualify for that child tax credit when filing jointly, well, as long as the children have Social Securities. And the single parent with an ITIN cannot claim child tax credit or additional child tax credit because the parent doesn't have a Social Security. So even if the children or the child has Social Security, that won't qualify for CTC and ACTC. Okay, so this is just more, and these slides are going to be shared with you, so that way you can take a look at these. But what will happen is that some of these, like earned income tax credit, it does required. So here it depends, right? Taxpayer here. So it depends of whether the Social Security is whether the children have Social Securities, whether the one taxpayer has Social Security. Earned income tax credit is even more restrictive. So both of them, so if you're filing jointly, both of you must have a Social Security. So this is something to take a look at. And California, though, so thankfully we're in California for this ITIN holder regulation, is that the Social Security and ITINs will still be accepted for the young child tax credit, for California child tax credit, and the California child independent care credit. Okay, so that's the big difference. Alrighty. All right. And here's the credit for other dependents. So remember that I said here that, well, if there are two ITIN holders, the children won't qualify for, or the family won't qualify for child tax credit. Well, the only thing that they could qualify for is the other dependents. So it's the $500. And remember, the $500 is non-refundable. So only if you owe taxes, you might be able to get the 500. But also, as you see on that picture here, is that other dependents is not just children. It could be other members in your family. So it's a 500 non-refundable, right? There is a phase out as well, and can be claimed in addition to child tax care, other dependent care. This child must be, let me see, age or older. So it could be 17 or older. So if on December 31st your child is 17, so let's say the child turned 17 on December 28th, right? Well, that child was 17 in 2025. So unfortunately, that's already an older dependent credit. Elder parents or other qualifying relatives, dependents living with you, and dependents with Social Security or ITINs, and dependents on any age. As we will see, sometimes you can have a dependent, but that doesn't mean that you're a head of household. Yes, things get very complicated easily. And here, for those people that have, where is the parent? Okay, for people that have parents anywhere in the US, in Canada or Mexico, you can claim your parent as that. Of course, they need to qualify. Actually, they need to qualify that you are supporting this person, and well, we will see again the qualifications for other dependents. But you can claim your parents even if they don't live with you, and they can actually make you a head of household. They have to, you have to pass all the tests, but yes. So again, it's non-refundable. So if you don't owe taxes at the end of all the math that you throw in there, with all the income, withholdings, deductions, if you don't owe any money at the end of the day, and the standard deductions, if you don't owe money, you don't have any liability. You won't be able to get any ODC, other dependent credit. All right, dependency. Okay, there we go. Must be a citizen of US citizen, Canada or Mexico, right? So yeah, so please, you actually, your parent could have an ITIN, so that might be something if your parent is in Canada or in Mexico. One return only. Of course, it's can be claimed like nobody can be claiming two, right? Into taxes. It has to be claimed on one person's taxes. No double claiming, of course, and not a spouse. 5 tests for the child. Again, we saw this slide earlier: relationship, age, residency, joint return, and support. The relative has 4 tests. Not a qualifying child, right? Gross income limit, 5,200 in 2025. I don't know how much is in 2026, but really, it's the person that is your dependent must be making very, very little or not being able to work in order for that person to be your dependent. Member of household or relationship. Relationship, well, is usually blood related. And the support test. So you are supporting more than half of the other person's needs financially. All right, key difference of head of household. So here we go. So what makes it a head of household? Having a dependent that is not your child, and you might qualify it as a head of household. Well, if it's a child under 19, 24 if a student, full-time student, and there is no limit. Actually, your child can be having a job, but I mean, if your child is 24, full-time student still, and if they have a full-time job, it's okay. Um, but it depends of how much support you're providing too, right? In the house. And most must live with you over 6 months, the 183 days. Qualifying relative, any age. The income must be under 5,000. I guess that's the number for 20. Actually, I don't know why I put that there. I'm sorry. Um, I think it must be the income, and I might have it wrong. I must live with you over 6 months and blood related. So let's look at this a little bit more. With these examples, we see the child. So age is 8. And so if you are paying for all the expenses, easy. Yes, you could qualify. Of course, given that you are not married or qualifying as unmarried, you can have the child as your dependent and can make you a head of household. And so if your child is 22, full-time student, also qualifies. But if Emma works full-time, not a student or no full-time student, then your child won't pass that test. And then if we take mom here, so your mom lives with you. Of course, she cannot be claim anybody anywhere else. And child or person, actually dependent. She meets all tests, and also, and again, remember that the parent, as long as you are supporting your parent over 50% of their financial expenses, the parent might not live with you. That's one of the very strange, good exceptions. And then we see a nephew who doesn't live with you but might qualify. So again, blood related, but also make sure that this person is not making over, the limit, whatever. Please check the limit for the year for 2026. So you know if your child will qualify for 26 or 2025 if you haven't filed your taxes. And okay, so if this person has no income, well then of course no need to worry about the 5,000 or so that must be the limit of earned income. So that could qualify. But if you have a girlfriend and lives with you, the gross income is 18,000, right? So maybe not enough to live in the Bay Area with that much, but it's more than the 5,000, right? It's more than the much much higher than around 5,000 that you need, and that doesn't qualify because of the gross income. I don't have an answer about the brother for you, Young. I know that the parents, when your parent is receiving Social Security, that is excluded. Uh, I I would think that the brother too, because it's Social Security, but please do confirm because I know that the parents can have that exclusion, but I don't know about the sibling because again, the parent is has a special something for taxes and not much with other dependents. All right, so adoption tax credit. So for those of you that might be adopting a child, that these are the numbers for 2026. Okay, now the fun comes. Education related. Remember that if you're filing as single, jointly, head of household, you could qualify for all these things. So double check with your filing separately, but these are some credits that you might be able to have while you are getting educated. 2,500 for the first 4 years of college. So the way that it works is very interesting. It's like 100% of the first 2,000 and then like 25 percent of the next 4,000. So anyway, it gets back to if I did my math right, I think I might have or not, but anyway, it's up to 2,500, but it's not like yeah, if you spend 2,500, we're gonna give you the all of the 2,500, but there is a math of like 100% of these and then 25% of the next. I think it's 25% of the next 2,000. Yep. That sounds right in my head. All right. So lifetime learning credit is up to 2,000 for tuition and fees at eligible institutions. And that is very interesting because that too is a percentage of the total up to 2,000. So I might need to refresh my memory, but I think it's at 10,000. You have to spend 10,000 and you can get that up to 20%. And that is the 2,000. That's how you come about to this. And the deduction of 2,500, that if you're making more than, is in the 80s, if you're filing single. So there are different numbers also, income limitations on when you can actually deduct the 2,500. And that for sure is non-deductible if you are filing separately. Okay, so I'm touching a little bit of student loans here because, well, I do that every day. So I work with people in different filing statuses, and I kind of want to give you a little bit of what's going on here with student loans. Um, and the reason I'm putting it here because what you make, your earned income has to do if you are with under the federal system, what you earn, and if you are on an income driven plan, well, your income matters, right? So if you are going to be paying based on your income, and by the way, it's not the gross income, it's the adjusted gross income. So any monies that you put pre-tax in your retirement account, right, in your 401k, 403b, and any deductions on your FSA, HSA, care for your children, that's going to be lowering your taxable fund, right? The balance. So if you're doing that, that's one piece. Like lowering that adjusted gross income helps. And also it matters what kind of repayment plan you're in. I'm not gonna go deeper here because it's a lot of information. But the ones that are so far surviving so far, because there is only one of these three that is going to be there in 2018 by the second half of 2018, 2028, I'm sorry, 2028, is income contingency repayment plan, income-based repayment plan, and pay as you earn repayment plan. And by the way, the SAVE plan, if you have heard news about the SAVE plan, is still not a qualified, nobody can get on the SAVE plan. And basically what happened a few days ago is that courts threw it back to the Department of Education, and they say, well, this is your child, keep dealing with this. That's pretty much what happened. So it's still in limbo, and we don't see that it will come back, but we might get surprised. But I'm not including it here because you cannot even get on Save, and people that are on Save are being told, go find another income-driven plan for you. Okay, so if you are any of the income-driven plans, RAP, by the way, that's the new one coming up this July 2026. And so it's going to be based actually on the adjusted gross income, not on a discretionary income that these older plans are based. I will cover a little bit more on this. But what happens with the older ones is that because it's based on the discretionary income, and you might wonder, what does that mean? Well, it starts with the adjusted gross income, right? So adjusted gross income minus 150% of the poverty line. So it could be 100 or 150, depending on of what repayment plan. ICR has lower protection of monies for families. IBR and pay as you earn has 150% of that poverty line. So adjusted gross income minus the poverty line, depending on the family size, is discretionary income. And then they say, okay, so this is based on 15 or 10% of your discretionary income, depending on when was your oldest loan. And again, this might be very confusing. It's a lot of information and it shouldn't even be here, but I just wanted to bring this up a little bit so you have an idea about what else you can do with your taxes and if you have debt. So then 10 or 20%, depending of what plan you have. Hi, Jonathan.
I just wanted to let you know we're getting close to 2 o'clock, and I know you generously offered to go past 2 o'clock.
Oh, what?
But
I just checked it.
I just
Wow,
wanted to give you I
that
just
went
wanted to
fast.
do a clock check there. So please continue.
Okay, already. So anyway, so this is thank you, Jonathan. I will go back. I'll go here quick. So this is based on a percentage of your income. So please, I'm sure there is more. Or reach out if you have any questions about this. But there is more presentations that probably have been done with student loans and find out about that. And that it really helps to lower your adjusted gross income. Okay, so and some of these things of why married filing separately or jointly might be helpful is because, well, if in the household is, in California, you take the full amount, but then if you, let's say you make more than your spouse, um, and then you file jointly, then that's the full amount that is going to be taken into consideration for income-driven plans. But if you are filing separately, well, in California, if you make more, let's say you make 100 and your spouse 50, 150, 75 will be your income, which helps lower that payment, right? So just bear that in mind, and then compare the savings with filing jointly in your student loans versus how much you will be paying as a household, and see if that makes sense. Okay, so just it might be a good idea, but again, it might be a trap. So just make sure the idea is compare how much more you're going to pay as filing separately as a household versus the savings. Okay. All right. So this will be shared with you, so you will see the numbers of what might be making sense of like how you should be thinking a bit about filing separately. And again, this probably doesn't apply for so many of you, so let's skip this. And one thing that is important here is that if you have children coming to age for college, please be ready because the limits of how much you can borrow for your child to go to college have lowered. So keep this in mind so you can plan ahead for your children's education or yours. All right. Some caps right now, right? 20,000, really? How much can you do with 20,000 that you can get as a Parent Plus? So, and same thing, just be mindful of the limits of how much you can borrow for your child. All right. So we saw credits, we saw dependency, filing statuses. All right. Credits for families. So they are a little bit lower than the federal credits, but they are those there for families. And again, people that have ITINs, they still have access to those credits. California Earned Income Tax Credit. There is a child independent care, and there, if you have children under 6, there is a youth child tax credit as well, depending on what income you have. All right. So up to 1189, sorry. And ITIN holder qualifies. So don't not do your taxes. Go do your taxes, because if you have an ITIN, because you can still get credit for your children in California. And here's that slide that I told you about, that in California, if you you have a home of $1 million, so they're going to consider just the 1 million ceiling rather than the 750 for federal. Alrighty, and okay, so this is the last thing. It's just a couple more minutes here. So IHSS, so this is for people that you are taking care of, that people that might need to be taken care of. Number one, IHSS, you have to be a medical holder. Okay, so if you have that, then you can get that service. Could it be somebody that is your relative? Yes, it could be. Is it taxable? It depends. Okay, so enables recipients to live independently. Caregivers are paid to deliver these vital services, covers essentials, and it provides an income for those that help others, right? With those essentials. And that's instead of going to like in home. I mean, like going inside a place where there's going to be separate from your own home. So if you want to be taken care of your inside your house, then that's when IHSS, in-home supported services, come into place. Okay, so this is the main thing. If you live with that person, the person that is receiving the services, then it can be the income can be excluded from your taxes, right? And there is also the one important thing here is that if that's the only income you have and you are also qualifiable, you will be able to qualify for credits, you can actually use it as income. And nowadays, softwares are able to help you put that as income, so that way you can have access to some credits. All right, so you have to live with a person, otherwise you cannot exclude it from your as income. And where do you see that? If you receive one of those, you're gonna see that in your W-2, everything has zeros except box 12. And it will have a code II, and it will have an amount, which is the number or the income that you had for 2025 for your taxes. And that's when a good software will ask you if you want to use this as income or you want to exclude it from like as an income for taxes to be taxable. So the provider might still elect to include payments as earned income to qualify for earned income tax credit. All right, so the election. So when you fill out the forms, you might elect. When you are doing your taxes, there is a second opportunity for you to include it in your taxes. And so this is the election form, SOC 2298. And you get a W-2, by the way. All right, so you're gonna get this slide again, and you will see what is going to be part of exclusion or inclusion on your taxes. All right, so there we go. And sorry, we went over 6 minutes here. And I know that we went really fast on the IHSS, but it's more about, do you live with that person? Okay, it might not be taxable. And then you go do your taxes. Do you want to include it now as for EITC, Earned Income Tax Credit? And then you can choose to do so.
Wonderful. Thank you so much, Rosario. Yeah, you were able to cover so much in just an hour. And yeah, with taxes and so much in personal finance, the devil is in the details. And I think you were able to really cover a lot of those details that relate to family tax issues today. So we really appreciate that. Um, I think yes. So I just want to remind everyone that later this afternoon, I will be sending a follow-up email that will include a link to a recording of the program, a PDF copy of the slideshow, so you can get all of those great numbers and breakdowns. And I'm also going to include a very brief evaluation survey that we send to all of our program participants. Please take a moment. It only takes like a minute or two to fill out. It helps us improve our programs and also helps us plan new programs. So if there's a topic you would like to see us do a presentation on, let us know in that survey, and we'll go find someone that can address that topic. Um, so I think if we want to, Rosario, if you want to take like a minute, if there's anything in the Q&A that you would like to
Yeah.
address, if the questions are out of scope, that we can also um, conclude the program. That's fine.
Yes. Yes. So EA and CPA. EA is purely tax person, enrolled agent, and they are highest designation with the tax with the IRS. CPA, there is a choice for them to be specialized in taxes. So not all CPAs do taxes. So they all have a general idea about taxes, but sometimes they work in firms doing more like accounting rather than taxes. So there is a big difference there. Specializing in filing taxes with children. What about retiree? I don't know if there is any specialization there. There are things to be mindful of with retirees is like when and this is more of a financial advisor or financial planner is because of from what bucket you are taking your monies out. That's very, very important for taxes because that could really give you opportunities to have monies for the future versus spending it all paying taxes today rather than keeping it for the future. Um, uh, I'm not sure if your child will qualify as a full-time student. Um, Yeah, so it all depends on how long the child and I don't know. We will have to see the specifics about from when to when the child was in school. So it might or it might not qualify for as putting the child as your dependent. I mean, as your dependent, it might be, but as yeah. So I don't have more. I will need more specifics for that anonymous attendee.
Well, thank you, Rosario. And that actually, I'd like to remind people that the Low Income Taxpayer Clinic is going to be here in person in the library for 3 more days. I'll include that information in the follow-up email. So, if you're able to come down to the main library on those days, you can actually sit for 30 minutes and talk to a tax attorney about these issues. There's no income limits for that. So if you have a very specific situation, that could be a good opportunity to talk to someone about those issues. Um, all right. Well, thank you again, everyone, for joining us. And thank you so much, Rosario, for your presentation. It was great. And we look
Thank you.
forward to having you back. And everyone, have a great afternoon and enjoy the weekend. Sounds like it's going to be a beautiful one.
Yes, yes, my pleasure. Thank you, Jonathan. Have a nice weekend as well.
All
Thank
right.
you. Bye-bye.
Bye,
Bye-bye.
everyone.